All right, we've got a goodly batch of colleagues here, so we're going to get started. Just so you all know, the session is being recorded, and we will let you know once we have information about how, if, and where the recordings might be available after the session. This is Ruth Toller Carter. I'm on the board of the SPJ Freelance community, which is hosting this event. And I am delighted to see people here. Welcome. Glad you could join us. I would like to introduce our presenter, who is somebody I have known for longer than he probably wants me to admit. He is Bennie Currie, who is the principal in a financial strategy company called MBC. He's also a journalist, which is one reason that I asked him to present this session for us, and has worked in corporate communications as well. Excuse me. He is a native of St. Louis, and he and his wife, Celeste Garrett, are both financial services professionals nowadays. They also both started their careers in journalism, so they understand what we're doing in the profession, which is a real plus with this particular topic. If you all would like any more information about Bennie's background, just let me know in the chat and I can send you that bio, but you should have seen it in the promotions for the event. And rather than take up more time on that, I would like to hand it, before I forget, I'm sorry. If you have questions during the session, please put them in the Q&A rather than the chat. And we will also be doing some polls throughout the presentation. So Bennie will point you to that as they come up. And I also would like to thank the amazing Hazel Becker for her tech support for this event. And on that note, Bennie, please take it away.
Okay, let me share my screen. All of a sudden now I don't see the icon because there we go. You guys can see my screen?
Yes, sir.
Fantastic. Let me get going. So Ruth already introduced me. I'm Bennie Currie, and this is retirement planning for freelancers. And like she said, we're going to have some poll questions and one real quick quiz that we'll go through. I also will again encourage you to drop whatever questions you have into the chat.
No, the Q&A, Bennie, the Q&A for the questions.
Yeah, and I will answer them as best I can. And then also, as I go forward, I will be sort of teeing up some of my subject matter with rhetorical questions that are aimed at getting you to think about what your answer would be to that if I was asking for that, or if you were needing to determine whether that was something that you need to be focused on. And before I get into that, a little bit more background about me, because I don't know if so we met in St. Louis. That's where I grew up. And my very first freelance job, if you will, was as a sports stringer for the St. Louis Argus, a Black weekly, when I was in high school. And Ruth was my editor. So that's how far back we go. Don't necessarily need to mention what year that was. But a year or so later, I went on to University of Missouri, studied journalism, started my career after my wife had already done so 6 months earlier at the Commercial Appeal in Memphis. We both worked in rural bureaus for them for a time, including Jonesboro, Arkansas. But when I left Mizzou, I really was thinking of starting my career, moving into public relations. And when I got an opportunity to do that, I did so. And so my first PR job was with Federal Express. It was so long ago, we didn't call it FedEx. It was called Federal Express back then. But then I wanted to get back to St. Louis to be closer to my youngest brother and my parents. So I took a job with Southwestern Bell Telephone. But I overshot St. Louis and they started me in Kansas City. And then about 18 months later, I finally made it to St. Louis. And so Celeste, my wife, was catching up career-wise. So she took a job with the Kansas City Star. Then she took a job in St. Louis with the St. Louis Sun, a daily that only lasted about 9 months. And then when it folded, she had three options, New York or Detroit. And we thought for my career, it might make the most sense to come to Chicago, which is where we've been ever since. And in that time, we've raised a couple of kids who are now young adults. They both were college soccer players and what have you. And every now and then, they're out of the nest. Every now and then they find ways to come back. My son lives not too far away. He does, he fancies himself a real estate mogul. My daughter is in medical school and is about 6 or 8 months away from becoming a podiatrist. So
Wow.
we're very proud of that. So I started in PR when I was in Chicago, but also during that time, and for a lot of different times when I was also in St. Louis, I did a lot of freelance work. I freelanced for the Tribune, WBEZ, the NPR affiliate. I wrote an essay for the Chicago Reader about a word that starts with the letter N, and and you can figure out what that means. But what I'm really proud of it because it got picked up by America Now, which is a collection of essays that English composition teachers use to teach English composition to kids. And a couple of teachers down in Texas, I believe it was, they actually got reprimanded or suspended for using it. And I feel that the only reason why that happened is because whoever did that didn't actually read my article, because I don't think that should have happened. But anywho, so yeah, but again, most of my career was in PR early on when I got to Chicago. But in '99, I got an urge to scratch the journalism itch again. So I went to the Associated Press for 5 years, took a significant pay cut to do so. So I did a lot of freelancing to kind of make up for that. But those two kids you saw were in private schools, so needed to make a little more money. So went back into PR. This time in the public sector, I went to work for the city of Chicago, including the office of the mayor at that time. And then a search firm came and grabbed me and took me to what ended up being my last corporate job, which was with Commonwealth Edison. I was a spokesman for when the power went out. No stress at all with that. And then shortly after that, I decided to do what by this time my wife had been doing. She started out as a journalist, worked about 20 years, worked in PR just for like 4 years as a director of PR for the Chicago Public Schools under Arnie Duncan before he went to the White House. And when he did, she started looking for other work and found work in financial services and ultimately started a career there. And then the powers that be asked me if I wanted to join her, and eventually I did. And so I ended up doing so and hanging out my own shingle with NBC Financial Strategies. And in my practice, I work with professionals such as yourselves and families and small business owners for wealth accumulation and work on financial risk management strategies with an emphasis on tax minimization. Because what I always try to say is when you retire, it's best that you can pay yourself as much as you possibly can, and hopefully the IRS as less or little as you possibly can. And there is a strategy for doing that, some of which I'll touch upon, because when it comes to your retirement, I always say it's not what you've earned or how much you make as much as it is how much do you get to keep in your pocket. And you'll see what I mean by that as we get forward here. And so one of the ways you also do that is by managing risk. And along the way, you'll see, some of the labels on my slides touching upon some of the different risks that you need to try to guard against. Market, are you too conservative? Are you too aggressive? Longevity risk. A lot of people are concerned that their money might not last as long as they do. And so how can you address that? And again, taxability risk, I'm definitely going to talk about that. Inflation, give you an example of how to address sequence of return risk. Are all of your eggs in one basket? They probably shouldn't be, but if they're in more than one basket for retirement, which basket should you pull from and when, and why might it make sense to make such a decision? And of course, liquidity, got to have cash flow. And then there's mortality risk. Some of it's a risk. There is an inevitability when it comes to one's mortality, but there's timing involved with that. And so there is a need to have planning to address that as well. And we'll talk about that. And so here's the first question for you in regard to retirement. What activity are you most looking forward to in retirement? If you could plug in your answers. And I'll give you a couple of minutes for that. Or a few seconds, rather.
Seconds are good.
Yeah. All righty. So when you think about retirement, and that's what this question is about, what do you think about? A lot of people are thinking about being able to travel globally, and what you see on my slide, if I can advance it here. Don't seem to be able to do, there we go. Is basically the world, Reykjavik. Maybe you want to go canoeing in Botswana or take a road trip to Northern Ireland or drive to south of France, take a tour through Guatemala, or maybe a hike through the Brazilian rainforest. Or maybe you're more like me. I don't really like air travel, but I love road trips. I've taken all kinds of road trips from Chicago to St. Louis, even some of the offshoots of the old Route 66. Looking forward to driving out southwest to Santa Fe one day. And I've driven all over the Bay Area. Love driving through the wine country, and love driving around in New York. Haven't been driven around in a stretch limo, but maybe for retirement, that's something you want to be able to do. But whatever it is, when it comes to retirement, you have to have a plan for it, and it doesn't happen overnight. It's not a sprint; it's a marathon. And how does one approach a marathon? You start where you are. You use what you have, and you do what you can to get from the starting line to the finish line as best you possibly can. And on that note, I'm going to tee up another poll question.
There we go.
Now, there's the answers to the first one. Traveling is number one. Look at that. So there you go. And the second question is about how confident are you in your long-term financial plan? So that should be coming up. I see working part-time. Yeah. I have some comments about that in retirement. Is Hazel?
We need the second poll, please.
Yeah. Or am I going to tee it up, or is Hazel going to do it?
I think Hazel's going to do that.
Okay, great.
Sorry for the delay, folks.
No problem.
There we go. Nope.
That's still.
Now that's still the
Yeah.
results of the first one.
Yeah, right.
Benny, do you still have access to the polls? I'm not sure why it's not showing up this time.
I do. I don't think that I do. I don't see it. I don't see that as a. I can share. I can annotate. I don't see a way to operate the polls here. No Q&A. I see that.
Sorry, but it's at the bottom and it's frozen on the retirement activities on my screen.
Oh man. Well.
Apologies. Why
Well,
don't you try? It should be at the
I'll
bottom.
pose a question, and you guys can just jot down your answers. So the question is, how confident are you in your long-term financial plan? Are you very confident, somewhat confident, not confident, or you don't have a plan? And perhaps maybe drop in the chat what your answer is to that question if you're bold enough to share that. There it is. Great.
There we go.
That's better. That's so that we don't out anyone on this.
And by the way, folks, while you're taking a look at the poll, I'm keeping track of questions, and we will get to questions more toward the end of the session.
And I'm sure everyone is checking that first bubble, right? You're very confident about it, right? I hope so. So I'm going to assume you've plugged in your responses, and I think I have the ability to click off of that. So I think it's always important to focus on 4 principles or 4 P's of planning when it comes to your retirement. Starting with protection of what you earned, what you own, what you owe, and those that you love. And I'll touch upon pretty much all of those. And planning for major life events, whether it's, that major trip around the world or retirement or college for kids or grandkids or going back to school for yourself, and having a plan to be able to afford those things. And basically, what are you doing with planning? You're bringing the future into the present so that you can do something about it now. It's very important to be able to do that. And here are the responses. No one is very confident. I was joking, but I thought at least there'd be someone that would say that, but somewhat confident is pretty good. Then not confident, okay. You don't have a plan. 21%. Hold that thought on that statistic, because you'll see what I mean by that. So let's see here. There we go. So in order to really effectively, execute a plan, you've got to prioritize your financial goals. You got to make that to-do list, and run through that, systematically, consistently. And the better you're able to do that, the better you're able to ultimately leave behind assets to people or institutions that you care about. In other words, establish a legacy. It doesn't happen to snap of the finger. It takes some effort to do that. And basically, when we're talking about your retirement or your retirement plan, we're building a financial house, so to speak. And when you're building when you're constructing anything, any kind of a building, it has to sit on a solid foundation. So at the bottom of that foundation would be protection. I'm going to definitely get into some details on that. Then once you're building the walls and installing the windows, that's your saving and your investments. Now we're into the accumulation phase. And there's even an element of protection that comes into play. And for a lot of folks, when you're into this phase of life, and there's also an element of protection into that third phase, which is the preservation phase. Some people call it conservation or a distribution phase, because now that you've built up retirement assets, you're living off of those distributions, and whatever is left, either by default or through your actual specific planning, is your legacy. But in order to build that house, you've got to have the right tools to be successful. So I'm going to get into some of those tools, but before I do, just a bit of caution, and that is that as you're trying to execute a plan, you've got to make sure that you're aware that, things can happen, things that can jeopardize your retirement. And so being able to identify those things is the first step to protecting yourself and guarding against these things shaking up the apple cart, so to speak. And these are the things. These boxes kind of represent the bricks that would make up the foundation of your financial house. If there's a crack in one, or if one's missing, that can be a particular issue. And I call the boxes on the top row your guardrails, if you will. And the ones on the bottom are various insurance protections that come into play for anyone's financial plan. We'll start with the first two, wills and trusts. And these are the documents that are going to ensure the proper treatment of your assets in the event of your passing or incapacitation. If you don't have that and you die intestate, your heirs, your beneficiaries are going to have to go to probate court, which can be pretty stressful and costly, and in some cases kind of traumatic for folks. I'm working with a business owner right now. He inherited a restaurant from his dad, and his dad didn't have an estate plan. He had to go through probate court. And we're talking now, because I'm helping him on some matters, to put an estate plan and a business succession plan in place for him so that his kids don't go through the same things that he went through. Then, of course, I call it rainy day money or emergency savings. Experts say you should have 4 to 6 months of your monthly living expenses in the bank, to absorb those bumps in the road. If you don't have 4 to 6, do you have 2 to 4? Can you begin to shoot for that? If you only have 1 to 2, maybe you're taking steps to get to that. But the bottom line is you've got to have some cash in hand for that unexpected expense, whatever that might be. For a lot of folks, it's the cost of pet care if they don't have insurance for their pets. Man, vet bills are very expensive. You got to have that kind of cash in hand for those things that come about. Then of course there's debt management, and with that you definitely want to have a prioritization. How do you deal with the debt? You got to have a plan for it, and you basically want to tackle the most important debt first and work your way down. But having said that, you've got your hand on that steering wheel, and you also have to have your hand on the savings and investment steering wheel. You don't want to have one cancel out the other, because both are important, and you got to have a plan for figuring out a way that will allow you to be able to address both as best you possibly can as you make that way down the road along your financial journey, so to speak. There are some people who are really into, continually giving to either their religious institution or not-for-profit, their favorite charity, and that's really important to them, during life, during retirement, and perhaps beyond the scope of their life. But you want to have a plan to be able to address that. Your estate planning attorney is going to be the one that would help you with that, and life insurance is probably going to be a vehicle that would help you with that as well. And speaking of life insurance, it's the cornerstone of the insurance items down below, starting with, of course, health insurance. And, I think we all understand the importance of having insurance to help pay for the cost of healthcare, which, as we know, is quite expensive. If you're sick and you don't have healthcare and you can't work, you can't save. So you got to be able to do that. And if you don't have a good plan in place, it's important to work with a healthcare professional for that. I have a health license, but I don't do that. I refer my clients to someone to help them with that, because again, it's very important to be able to address that. And on the property and casualty front, whether it's homeowners or renters insurance or your auto insurance, that's your property and casualty person is going to help you with that. And I always say, have a conversation with that individual, because those are insurance items that I don't deal with, to talk about umbrella insurance. Because if you had an auto accident and you get sued, how are you going to settle that case, or pay those damages? Umbrella insurance can address that. And I would say talk to your property and casualty agent if you haven't already about putting some of that in place. In a lot of cases, people might raise their deductibles on the home and auto to free up some dollars to pay for that umbrella insurance. I would use at least $1 million if that works for you budgetarily. But again, that's something you work out with your property and casualty agent. These next three are areas that I definitely deal in from day to day in my practice. And the first one is another rhetorical question, and that is, what would happen to you and or your family if your ability to earn an income suddenly came to a halt because you were disabled? Do you have disability insurance to address that? And it's very important that you do, because 63% of people say that it would be difficult, to meet their current financial obligations if their next paycheck was delayed for just 1 week. So if you have an employer that provides disability insurance, fantastic. It's probably going to provide up to about 60 to 65% replacement of your income. And I always say, if you got disabled and your household really depends on 100% of your income, that means you have a disability insurance gap, and you can get individual disability insurance to address that. And one thing about tax advantages, just like your payments from an employer-provided disability insurance plan, taxable. But when you have your own individual disability insurance, that will come to you tax-free. Now, the next one is a rhetorical question that's going to speak to the next. It's a quick quiz, and that is, are your retirement savings protected from a chronic care event? And I'll get into what that really means in just a second. And the question is, will your retirement? Nope. That's the last poll quiz. There's a quiz that should ask the question about true and false questions about long-term care. Yeah, there we go. So if you can answer those as best you can, We'll see, how much you know about that, but I'm going to spend a little time on this particular segment because I don't think there's nearly enough focus on that, given where we are as a society in terms of the amount of us who are getting older and older. And you'll see what I mean by that. If anyone gets 100%, I will be thoroughly impressed. And I hope that you do. So, what is a chronic care event? It's when you can't do an activity of daily living. And what is that? If you can't clean yourself, cook for yourself, dress yourself, transition from one room to the next without the assistance of an individual or machinery or gadgets and what have you. If you can't do two of those, you would qualify for a long-term care insurance claim. Now, a lot of people will hear me say that and go, well, yeah, I've got health insurance. Health insurance is going to take care of long-term care. I'm good on that. Whoops, put that back up there. Let's see how we did. I didn't mean to close that. Wanted to see the results.
I can read them to you. 12 of 13 said the first question was false, and it is.
Okay. Great.
And 13 of 13 said the second question is true, and it is. And 13 of 13 got the third question right as false, and 10 of 11 got the fourth question right at true.
That's great. So I would assume that you guys already know that if you were thinking about health insurance covering long-term care, that you already know that doesn't, and we'll get to that. But are you aware that about 70% of people who are 65 and older are going to need some type of long-term care service during their lifetime, but less than 7% of people who are 50 or more have a long-term care plan in place? And I think the earlier you do it, the better. And that's why I'm trying to focus on that. But again, like I said, health insurance won't cover it. That pays for doctor's bills and hospital bills, but not for an extended care kind of a situation. And if you're folks who are around my age, which is pretty close to Medicare age, let's just say that, you may be thinking, oh, my Medicare plan will take care of that. Well, not really. In most cases, it won't cover it. In the cases where it would cover it, it'll only cover up to 100 days, a little bit over 3 months. And you'll see why that really won't work. And also, you'll see in the chat a link to a on-demand webinar video that will kind of really walk you through in more detail the ins and outs of long-term care planning, although I'm going to touch upon it quite a bit here. Because the best way and the most robust kind of way to address a long-term care situation is to let an insurance company take that risk off the table with a long-term care insurance plan. I shared this with one client once, and she said, "Oh, just pull the plug. I don't want that." And I had to let her know that that isn't the only way one is in a long-term care plan. In fact, 90% of people receive long-term care either at their home or in a community setting like assisted living or what have you, not necessarily at a nursing home. So once people understand that, then the question is, so how much is this going to cost me? And well, the average lifetime cost per person in today's dollars is about $172,000. And the average length of a long-term care experience is about 3 years. In Illinois, the average cost per day is about $250 to $300 or something like that. So again, if you got Medicare covering it, and the average length is about 2 to 3 years, you got 30 days covered. What about the the rest of that time? How are you gonna, for 3 months, how are you gonna handle the other 27 months? So, or I got my math wrong on that, but some people will say, well, I'll pay it out of pocket. I'll just use my assets. I'll save up for it perhaps. And so if a 55-year-old were to start saving money to reach 172 grand over 20 years, they'd have to save about $700 a month to do that. But what if you have a long-term care event at age 56 or 59 or what have you? That's not going to work. But a 55-year-old male who has an insurance plan covering about $175,000 of care, it pays about a little over $100 a month to be able to do that. And the real focus for looking at people that are in their 50s, I believe, is that it's just like life insurance. The earlier you do it, the less it's going to cost because it's based on your age and your health, but also the greater your chances of qualifying for it. It's kind of the old adage: if you need it, you can't get it. So if arthritis is kicking in or other morbidity challenges are kicking in, that's going to count against you, and it makes it difficult. So the earlier you do it, the better to be thinking about it. And so I recommend that you don't look at it as some kind of a throwaway expense, but rather as what I call retirement savings insurance. Just like you don't expect your car to get totaled, but if it does, you're covered for that. But what happens if you're in a long-term care event? Look at it as a safeguard for your retirement assets. And this couple on the screen certainly did that. And yes, that's yours truly and my wife. And very early on, we put a long-term care plan on the books, but when we realized that we were actually fairly new into the whole game and didn't really think it through as thoroughly as we should, but we recently did that. And so we now have a second long-term care plan in place that we just put on the books a few weeks ago, actually. And one of the reasons why, again, I wanted to focus on this is because of what the census data is telling us. People are living a lot longer, and I think the senior population, however you want to define it, I'm going to go for 65 plus, is one of the fastest growing segments of society. From 2010 to 2020, that segment of society grew 5 times faster than everybody else. Overall, it was about 7.4% growth during that period of time. It's like 38% growth for people 65 and older. You're living a lot longer because of minimally invasive surgeries and, better health care, better nutrition and what have you, and I mean, we all know, tons of stories of people living to 90 and 100. Jimmy Carter voted, I mean, he wasn't supposed to be here, but here he is still here. And there are a lot of people that are making it to the triple digits. And this reality is also being recognized by state legislators. So in the state of Washington right now, because federal government handles Medicare and Medicaid, but states have to administer these programs, and it's challenging for them. And so to deal with it in the state of Washington, they have passed something called the Washington CARES Act. And if you didn't have a long-term care plan in place by, I think, Halloween of 2021, and it took a while for them to fight through the morass of politics to get it approved, but I think last year they finally implemented this. They are charging a payroll tax to employees, and then they use that to give people a long-term care plan that probably wouldn't be the one that, if they got it on their own, that they would want to do, but it's giving the state some peace of mind that they're doing something, because again, people are living longer and they want to make sure that people have something in place to address this particular issue. So this particular approach is building momentum in the state of California. I'm in Illinois. They tend to follow what California does legislatively, and these other states, Minnesota, Michigan, even New York, are looking at it. I think eventually every state's going to be looking at it because every state is dealing with a rising senior population. And so I put that out there just to make sure that people are thinking about that. And then here's another question I want you to be thinking about, and that is, do you have enough protection for what matters most if you die too soon? And of course, I'm talking about life insurance. And, I always say, life insurance is protecting your most valuable asset, which isn't your home or your car, but your ability to purchase those things, your income. But the thing is, we tend to have full protection, replacement value on our car, our house is covered. If we've got a homeowner's policy, you've got a mortgage, you got to have one. We have these phones covered. If it falls in the toilet, you can go and get another phone, pretty quickly. But when it comes to our income and our life insurance, sometimes that isn't necessarily addressed as significantly as it probably should be. And there's two main ways of doing that: term insurance or permanent insurance. And term insurance, I always say, that's like renting an apartment. Just like a lease is going to expire, your term policy is going to, at some point, the guarantee period is going to expire. You can renew. It's going to be based on your age and your health at that time. And so the cost will be higher when you do that. And hopefully you're still able to qualify for it. But the research shows that the majority of people, when they pass, the type of life insurance is going to be in place to take care of those final expenses and what have you is not term insurance. If you live a long life, it's going to be permanent insurance. Another way of describing permanent insurance is cash value life insurance, and there's multiple types of that. But the thing is, this life insurance, so yes, it addresses mortality risk, but there are also benefits from having permanent or cash value life insurance, particularly in play during your retirement years. I'm just going to run through these really quickly. So you can obviously leave a legacy of a death benefit tax-free to your beneficiary. It'll pay for your final expenses and state taxes and things of that nature. You can also use life insurance to replace lost Social Security, replace the income that's lost after the death of your spouse. You can use it to maximize your pension if you opt to take that single life pension, which would give you a higher payout. You can do so with the peace of mind that you have life insurance to replace that lost income after that pension holder passes away. A lot of folks have IRA money or old 401k money that their kids might be the beneficiaries of, and so they're going to leave that behind for them. But they may not be thinking about the fact that if that's qualified money, pre-tax money that's going to be taxed in the future, you may be bumping those beneficiaries into a higher tax bracket, something that they may not be that comfortable with. A way to avoid that is to, if you don't need those monies for day to day, take some of it out, buy some life insurance, leave behind a tax-free death benefit instead that might actually even exceed the account value of the IRA that you were leaving to your loved one. So again, that's a strategy for leveraging life insurance that you might not have thought about. You can also use it to lessen the impact of taxes. I'm going to go into that in a little more detail later, but basically, cash value in a life insurance policy is money that you can utilize tax-free, and the more you can build up while also lessening the amount of taxable income in the future, the better. Because again, Uncle Sam's going to get it. The only question is not if, but when and how much. And you can use life insurance in a way to minimize that impact. And I'll share more about that in a sec. You can use it to also make the most out of Social Security. You can become Social Security eligible at age 62, but if you wait until you can get full Social Security, you can have the benefit of being able to do that because you can use the cash value in a life insurance policy for income in the interim. That same cash value can be used, again, to supplement your retirement income, and also to be used is what I call a buffer asset. So that's what I mean by sequence of return. So if you've got an investment account that's going to be generating retirement income for you, and that's fantastic. But if you're taking withdrawals when the market's down, let's say it's 2008, 2009, you're taking a huge hit when you're taking that money out. Do you have another bucket of money that you can access that won't have, that won't be impacted by the market? If it's, say, whole life insurance, for example, that won't be in the market. It doesn't grow as aggressively as your investment, but it's money that's going to be there today and tomorrow. And so while the market's down, you take the money from the cash value life insurance policy, live off that. When the market rebounds, you turn off the one spigot, and then you go back to taking the withdrawals from your retirement account. So if you can do that, that can enable you to not actually realize those losses. So again, these are all different living benefits of life insurance that can definitely have an impact on how you experience things, life, so to speak, during retirement. So now we're going to talk about some savings and investment strategies and tee up that last poll question. And that question is, where will you get retirement income? Where do you expect the majority of your retirement income to come from? So those answers will pop up shortly. And in the meantime, I'm going to pose another rhetorical question in the interim, and that is, how much money do you need for retirement? Another way of looking at that is, how much money do you want, or how much money is required? Here we go. Savings and investments is the clear winner there. And I see 0 for employer pensions. Not at all surprised by that.
Although keep in mind, the participants this evening are freelancers.
Gotcha.
Some of us might have pensions from previous full-time jobs or spouses with pensions.
Yeah.
It's better to not count on those as somebody whose husband's pension fund got killed when the company went out of business. So even having that isn't a guarantee of anything.
That's true. And fewer companies, pretty much since 1980, have been wanting to do pensions. So if you're lucky to get one, great. You know, if you're a government employee, you probably can experience that, but non-government employees these days, maybe not so much. So, you know, you have to, as this next slide says, understand what your retirement number is, if you will. What should your monthly income look like in retirement? What do you want it or need it to look like in order to live the lifestyle that you want? And then once you know that, you know, what is the plan to be able to generate that? Now, embedded in this, and this was, I think, an article I kind of did a cut and paste from Kipler, I believe. You see up there, an ARP survey found that 1 in 5 Americans 50 or older have saved nothing for retirement, while more than half worry that they won't have enough money to support them in their golden years. And in the chat, you'll get a link to this article by Morningstar, which is an investment management research firm that people like me use to build investment portfolios for their clients. And they conducted this study to say that 45% of Americans who retired at age 65 are likely to run out of money before they pass away. Single females, 55%, couples, 41%, single males, 40%. And here's what happens if instead you decide to retire at age 70. 28% of Americans are likely to run out of money before they pass away. Single females, 36%, couples, 26%, and single males, 21%. So the one way to kind of at least guard against this, or at least put a plan in place for that, is to have someone work with a financial professional to do a calculation to see what is required to generate the amount of income you need to live the lifestyle that you choose for retirement. I have a number of different ways to do that. This one is called a financial EKG. Hopefully you don't need a medical EKG after the numbers come out. But you know, it's important to understand, you know, where you're headed and what you need to do to get to where you're trying to go. So this 40-year-old wants to retire in 25 years at 65. They're currently making 100 grand a year. They're thinking they can live on an income of 80 grand for retirement. So we factor in a very doable rate of return while they're saving and investing, 7%, and then 4% for the retirement years. And we also want to address inflation. And because, you know, the dollar today is worth a lot more than it's going to be tomorrow. So you want to make sure that when you're doing this calculation, you're factoring that into the mix. And we use something called the rule of 72, which is where you take an interest rate and you divide that into 72. That tells you how long it takes for a dollar to double. But if you converse that, then it tells you how long it would take for your money to run out. So we're factoring in inflation at a certain rate. You choose what number you want, 3, 4, what have you. Also, what's missing from that is a life expectancy. It used to always be 87 or so. I'm usually going for 90 now, because better than, you want to assume you're going to live that long and make sure you're planning to be able to have money that's going to last that long. And so we plug that into the calculator, so to speak, and it says that this individual needs $2,400 basically per month to build up their bag of money of $2 million. That's how much is needed to generate enough interest to provide $80,000 of income. So let's say the individual says, well, gee, I'm only saving $800 a month right now. And, the best I could probably do is maybe $1,800 a month. I don't know about 2,400. So you have some decisions to make. Either you're going to plan to live on a lower annual income, or maybe decide to work longer. And like the Morningstar report indicated, that could actually be beneficial to you. So let's say you decide to retire at age 70. Now you need $1,600 a month based on these numbers. So that individual with the 1,800, I would tell them, you know what, if you can handle 1,800, I would recommend you still go ahead and save that 1,800 despite the 16. Why? Because of that big red dot down there. That's life. You start out on the straight line, everything's looking great, everything's fantastic, but we know things go sideways sometimes. You have to make, mid-course corrections or what have you. And sometimes we get a little off track. So it may take us a little bit longer. But it's important to understand, I call it financial EKG, but, these kinds of calculators really like a financial GPS. I'm trying to get from Chicago to New York on Sunday. And I'm driving. How fast do I need to go? What route should I be taking? And what happens when I get pulled over by I never get pulled over by the cops. Or if there's a construction, delay or what have you, what do I need to do to catch back up? Because I still got to get to New York by Sunday. But if, something like this is done and you go, Mr. Currie, this is fantastic. I'm going to jump right on this, but you procrastinate. And the next thing you know, 5 years has passed, just at 3% interest, now you need $3,800 a month. So you really got to do some catch up, or again, drop that 80 down to 65 or whatever it needs to be. But have an idea of what you're wanting to do, and then realize what you will need to do in order to get there. In other words, don't be flying blind. I've talked to a number of people that have saved in a 401k for many years, but they don't really, have an idea as to what that's going to look like necessarily. And one of the things they really haven't thought about, if it's particularly just a 401k with only pre-tax money, is the very real fact that they ain't getting all of that. And we're definitely going to talk about that. But before I do get into that, I want to talk again about this, very real possibility that you could live a very long life, and again, ask yourself, are you at risk about living your money? And based on that survey response, I'm guessing the answer to the sub question down there is that you may not have any guaranteed income, at least not when it comes to a pension. That's, one source of guaranteed income. Social Security is also one. All that, we hear all the talk about people doing away with Social Security. Boy, you're going to cut away a government program, for seniors who vote in high volume. I don't think that's going to really happen. There's a lot of talk around that. I think Social Security will be there, but Social Security was never really meant to fully fund anyone's retirement, and it really shouldn't. You need to be able to be saving other assets, and we'll talk about that. But whether it's Social Security or your pension, that's your monthly fixed income that you can plan around to deal with your needs, your food, your clothing, your shelter, pay those healthcare insurance premiums, and perhaps long-term care as well. But what if it's not enough? And how could you possibly get some other guaranteed income, not having a pension from an employer. I'll show you. So down below are, your discretionary funds, your savings and investments and your mutual funds, stocks, 401k, CDs, what have you. These are the assets that you're going to be using for those wants. You want to travel, you want to entertain yourself, join, the AARP or the Kiwanis Club or what have you. Be able to buy gifts to spoil the grandkids, and then be able to leave behind a legacy of some sort for those grandkids and what have you. But let's say, and a lot of us have worked for multiple employees or employers rather, and maybe we left the 401k sitting there, or maybe we rolled it over into an IRA that's sitting somewhere, but you have been contributing to a larger plan elsewhere. You might take that, that IRA or that old 401k and roll it over into what I call a personal pension or an income annuity. It's still qualified money. You give that to an insurance company that's going to put that in a chest, and they're going to guarantee you a payout that you won't outlive. If you do it immediately, you're going to get a certain pay amount. If you pay out, if you decide to defer that, you'll get a higher payout. You might even be able to set up one where you can contribute to it over time to boost the payout that you get. And now that is, again, more dedicated funds that you can plan around and have some peace of mind that the rent, the mortgage, whatever is going to be paid for those things. I have a client who wanted to get actual long-term care insurance, but has some health issues that made her ineligible to get it. But her mom's 90 plus, and she's 75, and she just she figured that's going to be her future. But she said, well, what could I do? She didn't. She was a former economics professor, so she had some IRA money from or 403b money from one of her employers. If she rolled over into one of these, to strictly use that for her long-term care down the road. So that's one way to, if you don't have a pension, create a pension-like asset for yourself to help deal with retirement in a way that gives you some peace of mind. And so my last rhetorical question is, are your savings and investments properly allocated? So what you're looking at here is vertical diversification of your savings. You have a statement and you get this pie chart. The largest number is usually your stocks, 60%. So this is a 66-34 asset allocation. 66 is your aggressive money. The other 34% is your stocks, bonds, money market, and what have you. The Wall Street rule of thumb says that you should have assets equal to your age in the safe area below those dotted lines there. So if you're 25 years old, you'd have 25% of your money below the line and 75% of your money in a more aggressive position. And if you're 50, 50. But if you're 75, really wouldn't make sense to have 75% of your money in the market, because if it takes a big hit, will you have enough time to recoup the losses? The market will rebound, but it takes time. But do you have that time? So what you want to do is be more conservative and maybe have 25% of your portfolio aggressive, but the rest of it in the safer area. Because what you're doing in doing that is taking those paper assets and systematically over time funneling them down, becoming more conservative as your age goes up, to put that below the line into a bucket that's going to be what we call stable wealth. Again, that's money market, cash, some bonds as well, money that's not going to have that volatility, because this is what's going to be here today. This is what's going to be here tomorrow. This is that nest egg that you're going to be living off. And so you do that over time so that you don't incur, the ravages of the market if you're too aggressive. So that's vertical diversification. And now I want to talk about horizontal diversification. And that's diversification in terms of the tax treatment of your money. And there are two types. The first is pre-tax.
Excuse me, Benny, excuse me.
Yeah.
Let's keep in mind that it's about 5 of the hour and we
Okay.
want to keep time for questions. I've got 4 or 5 questions to go to when you're done.
Okay. All right. And this is going to be done in about 5 minutes. So, so pre-tax, your 401k, 403b, traditional IRA. These are all pension, simple IRA. These are all vehicles that are fully taxable at whatever the tax rates are at the time that you take distributions. And then keep in mind that right now we're in a very low federal income tax environment. But if you're not ready to retire now, where tax is going to be in the future is something that you need to think about. Because tax, deferral may not be the best strategy given where taxes may be going in the future. And this guy, Ed Slott, he's a CPA with the American College of Financial Services. As his quote says, taxes are going to be the single biggest factor that separates some people from their retirement dreams. And what am I talking about? Well, right now we know that our current federal taxes are going to change at the end of 2025. This Tax Cuts and Jobs Act went into place in 2017, and it will expire at the end of 2025. And so if you're at the highest marginal tax rate today at 37%, on January the 1st of 2026, you'll be at the 39.6 rate, or wherever your rate is today is going to go back to where it was in 2017 due to this tax cut expiring. So it's important to understand every time we cut taxes, we raise the debt. And so the current national deficit is around 33 trillion. The only way the government can whittle down these little red dots here is to raise revenue. You can only do that by cutting government programs or by raising taxes. And you can see the volatility in the higher income tax brackets in the orange there, less volatile in the blue. The more you can have non-taxable income for retirement, the better your chances of your tax rate staying low. But that doesn't happen magically. You have to actually do that in an active way. And it's also important to know history. 1980, around the time that corporate America said, hey, we're going to start giving people 401ks because they changed the tax laws back in 1978. But back then, the highest income earner was at a 7% tax rate. And if you're making 100 grand, you might have been paying about 40% in taxes. So it would look really great to be able to defer that and not and avoid that tax hit by putting your money in a traditional IRA or 401k. And 40 years later, you look like a genius because now you're taking those withdrawals with a lot lower tax rate. But if you're not ready to retire and you got another 10, 20, 30 years or what have you, how do you, avoid, the I believe potential increase in taxes? You look at the after-tax side of the ledger, federal tax-free municipal bonds, cash value life insurance, and Roth IRA are the three popular places to put money on the after-tax side. If you're going to be doing it with a Roth, I would put that above the line into the aggressive area, but the bonds and cash value life insurance could be some conservative places to save money on an after-tax basis. And real quick, this is what that can look like in terms of, diversifying your portfolio. If you've got $100,000 of income, this is a tale of two incomes. The first is all qualified in a 401k, 100% taxable with whatever the rates are at that time. Today, $100,000 would be taxed at 22%. That's $78,000 to spend after taxes. We're just talking federal here. Down below, diversification, half of the money isn't qualified. Now we're talking the 12% tax rate on that income, $6 grand. On the other side, I'm showing cash value life insurance in the example, but it could be a Roth IRA, zero taxes. So when you think about it, you have $100,000 of income, but only $6,000 to pay in taxes. That's an overall, tax equivalency of 6% on your money, leaving you $94,000 to spend instead. So, which looks better. And it's pretty simple, 78 versus 94. And we all know it's 94, but that comes with some actual planning. And the thing is, again, we don't know where taxes are going to go, but you want to have a pre-tax bucket and an after-tax bucket. If you get back to the Reagan era of taxes, we'll put more on the deferred side. But right now, when taxes are in a low environment, you got to take advantage of that. I'm an old football player, so you take what the defense gives you. But that's pretty much a real quick and dirty kind of view on how to diversify your savings from a tax perspective. Because like I said earlier, it's not what you earn as much as it is how much do you get to keep. And I'm going to close it there and open it up for some questions. And while I do that and try to answer them, Just a couple of QR codes and screen. There's also should be a link in the chat to my Calendly if anyone wants to talk individually, or you can take a picture of that QR code at the bottom to get that link as well. And the one up top is my website, and there's my other contact info. And I'm gonna turn it over to Ruth.
To me.
Yeah, the
All
question.
right, thank you, Benny. I'm going to just pick up on the questions in the chat, not necessarily in the order that they came in. The
Mhm.
first one that I think would be very easy to answer is quite a few of us don't have kids,
Mhm.
but we've always assumed that life insurance was intended for people with children. For those of us who are childless, whether we're cat ladies or otherwise, do we need life insurance?
Yeah, well, like I just said, it depends. If you're in a relationship, there are some particular advantages to having it. But also, again, um, you know, um, passing away is something that we're all going to experience. So you need, and how is that going to get paid for? Who's going to do that? So you want to make sure, if nothing else, that you address that. So you want to make sure that someone can bury themselves, and if there is someone that depends on your income, a significant other, make sure that while you've made sure that they can bury you, that you don't bury them in debt. So that's how you look at that. What if there's still mortgage? How's that mortgage going to get paid if you're not there to help your spouse pay for it? That's one way to look at how much life insurance you need.
Okay. All right. And then I found a couple of these as very, something I hadn't even thought of. But when it comes to long-term care legislation at the state level,
Mm-hmm.
if it's based on payroll taxes,
Mm-hmm.
would that be moot for freelancers?
It's a good question, because I didn't research that beforehand, and I have a feeling they're going to find a way to get you anyway, because again,
Okay.
they're concerned about seniors, and it's a cattle prod, but I think that's what's going to get worked out legislatively. I've asked my state senator to give me more details on what's happening in Illinois. For some reason, he hasn't gotten back to me. So that's a very good question. But it's reach out to your state representative rep or senator, and ask them if they're talking about it, or maybe see if they can get you some intel on what they're doing in Washington, because I'm not exactly sure about that.
Okay. And then this is a piece of string question, perhaps. How long is considered long-term when it comes to long-term care and long-term care insurance? Is
Well,
there any kind of a standard for how long they think somebody might need that kind of coverage?
like I said, the average length of care is about 3 years. For some people, in the case of both my parents and my in-laws, it wasn't that long. But then there's people like I always say Superman needed long-term care. When
Yeah.
he fell off the horse, he ran out. He was self-paying. He ran out of his assets, and he was paralyzed for quite some time. But he did have Robin Williams to write him $1 million check. Most of us, no one has anymore, unfortunately. But most of us don't
And
have a healthy, fellow actor friend to write us a check. So it kind of depends. But one thing to know is, in most cases, in a long-term care plan, it's just like with disability insurance. Part of the pricing is based on an elimination period. So if your situation is going to be more than 90 days, and you can't do these activities of daily living, it makes sense to have a plan in place to address it. You self-pay for 90 days, and then you go on claim, and now you're getting your payments. And I always say, if the average cost in your state is 200 a day or 300 a day or what have you, but your budget only allows you to do 75 a day or what have you, something's better than nothing. And so you do as much as best you can.
And I know from personal experience, my mother was bedridden for about 9 years at home, so we didn't have to pay for a nursing home or anything like that, but we needed aids. And most of that, after the first, probably year or two, came out of her savings. So we were lucky that she could self-pay, but
Yeah.
that's something to keep in mind for the future. So
Right.
the other two questions that I think are the most perhaps relevant to the group here. Number one, what if you're 50 and the pandemic wiped out your 401k? or what if you're 50 or so and your Roth IRA savings and whatever income you're generating as a freelancer are not keeping up with inflation? Freelance income is barely allowing you to save very much, and nobody's hiring you full-time because you're 50 or over, regardless of what a great track record you have. Is there anything one can do who's currently in that situation? Those of us who aren't yet, we can start doing more saving. We can start looking for assets to accumulate. We can start cutting back maybe on our living expenses. But for those who are in the middle of that kind of situation now, Benny, is there anything they can do other than get a job at Walmart?
Well, hopefully maybe not necessarily Walmart, but I mean, I think, so the one thing I did mention earlier, for a lot of people, retirement isn't necessarily, okay, I'm not working anymore and I'm just living off whatever I've got. You just may reach to a point where you're no longer at the same income level you were maybe when you were in your 20s and your 30s and your 40s, but you're still doing work, if you're able to do that. And I think a lot more people, I thought that number would actually be higher, of people doing part-time work during quote unquote retirement. I plan to stop doing what I'm doing at age 70, but I'm pretty sure I'm still going to be working. I'll probably be doing freelance writing or something, because I want to keep active. But if income or savings is a challenge, that's something you're going to really have to bear down and try to put a plan in place to address. But the other thing too is figuring out ways to minimize, your expenses day to day, and really taking an assessment of that. There's great spreadsheets, and there's even one I share with my clients where you plug in what things cost that you're spending dollars on, and then reassess whether you need to continue to do that. Like I used to buy 2 cups of Starbucks with a couple of pumps of caramel every day. Till I did the math on that, now I make my own coffee, things like that. They do add up over time. When the kids were small, we stopped ordering pizza out and started, getting Boboli, bread shells and making our own pizza. Save money when you do that. And so you make lifestyle changes and household budgetary changes to minimize the amount that you're going to have to save, because you got to try to catch up. And that's one reason why I like to emphasize financial risk management. So it's not so much how much you can add to, but what can you do to protect yourself against things that might detract as well.
Thank you. I don't see any other open questions. I would wrap it up by saying, of course, thank you so much for doing this for us.
Yeah.
And those of you who are attending, do take a look at the links that Benny has provided in case you would like to talk to him in further detail. And I would strongly, based again on my own experience, I'm now 71, and I expect, as Benny does, I expect to keep working till I fall over, but I try to pay myself first. So if you are generating any freelance income, one trick you can use is to take at least 10% of every payment and put it aside in a save, even if it's just a bare bones savings account. Just get in that habit and do so now, especially the younger colleagues amongst us, so that you have that mindset of keeping some of those funds. You might end up using some of it for taxes, but if you have enough deductions that your tax bill is low at this stage, it should be a big help to have that as kind of an automatic act at every payment. And the other that I would suggest is just keep looking for those freelance outlets. There are a number of platforms we can use that may not pay very much, but again, something is better than nothing. And we also need to think outside traditional journalism, because we can apply that journalism experience and skill set to the nonprofit sector, to businesses, to service firms like law firms and accountant firms. There are a lot of entities that need our services and our skills. It's time to maybe start looking for some of these other ways to make a living from our writing skills or our journalism experience.
I totally agree. That's one observation I've made over time is that there's an extreme need for writing and editing because there are a lot of people out there who think they know how to do that and they're horrible and they need help.
Yeah.
That's for darn sure.
The other thing I would keep in mind for that perspective is, and I know we've talked about this within SPJ and elsewhere, but one of the good reasons to do as much as we can now to save in whatever format is comfortable is because AI is going to keep making inroads into our profession. And publishers are going to use that more and more so they don't have to pay us what our skills are worth. And knowing that that's a likelihood, if not a reality, means we have to be more aggressive about thinking about what we will need if and when we retire.
Yeah, I don't know enough about that whole AI thing, but it's troubling, and I encourage everyone that's concerned about it to do as much uh, 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 to gather as much intel about it and to stay on that because they're going to have to manage that. Of course, you said a lot of the same things about the internet, and somehow that got out of that got out of control. The newspaper industry certainly didn't quite figure out the internet in time. But there's this opportunity to really get up to snuff on AI because it's not the be all to end all. But the question is, where is it going to go, and what kind of
What's it going to do to us? Let me throw one last question for you, Benny, and then I think we'll wrap it up for today. And I think this is correct. Don't self-employment taxes cover long-term care similarly to if it's based on payroll taxes? Would those be somehow equivalent?
That's probably a question for a tax professional. I'm not
Okay.
exactly sure, but again, now that you know that this is something that's out there, hopefully let your state rep do that work for you, and get an answer to that. Like I said, I've got mine working. He hasn't gotten back to me yet, but I want to know.
And for those of us who aren't members yet, I believe, I can't swear to it, but I believe I've seen some information along those lines through AARP, which is a great resource for all kinds of things, including retirement planning.
Absolutely, yeah. If you're not a member, and I highly recommend it. I subscribe to their text and to their emails. That slide I created with that survey, it's exactly where I got the prompt from.
All right, Benny, thank you so much. It's such a treat to still be connected after all these years. And again, if there's anything else that our group can do to help or that Benny can contribute to any further questions, please feel free to get in touch. And let's see, very quickly, there is a freelance solidarity project in the chat that you could look into to get more information about the impact of artificial intelligence. We are tentatively planning a webinar for December about tax planning. And please, if you're not already a member of the freelance community, please join us and let us know what else we can do to help. So again, thank you, Benny. Thank you, Hazel, for the tech support. And especially my very deep thanks for everybody for being here tonight. Let us know if there's anything else we can help with. And on that note, guys, thank you very much and good night.
Good night, everyone. Take care.